Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, May 30th, 2024. It's 3:38 p.m. So I'm hoping I can whip this one out quick, get it out to you before the close. Probably doesn't matter because I'm not going to change much what I've already gone over. I just wanted to kind of recap things and I did want to add something else on the equity markets. I'm going to speak to the other trades first. I've said this the other day, kind of disengaged quite a bit with a combination of you hitting price target. We had natural gas, a wheat, soybean, corn, all those hit price targets where I figured we'd probably at least consolidate, maybe pull back. And so I'm really, right now focused largely on the equity markets. There are, of course, there's nothing wrong being diversified in those other things. I will update those when I get requests. Things have quieted down. I have put 3 posts out today. I've had 0 comments. So, and I got the emails on them. So it's summer. It's we're smack into, kids are off school. If you have kids, grandkids, whatever. So a lot of people taking vacation, but let me dive into the charts here, guys, and I'll just show you what I'm seeing. And something I was going to share with you the other day. Figured, yeah, well, I'll throw it out here. It's an indicator. It's indicator, a take on an indicator. I didn't create the actual indicator, but I modified it, and I want to go over that with some other indicators that I do have on my own that I track and have made up. So this is QQQ. Just to kind of recap, we had the bearish engulfing candles, the trend line break. So we're multiple sell signals, all coming off the divergent high. Broke the trend line with the bearish engulfing candle. So there are multiple reasons to be short. Add a new short there. Again, that's based on the last trading plan. Swinging down here, that was T2. No more shorts added there. Stop out above there. Re-short back here, and this was a much better. We've had more evidence here, in my opinion, and bigger divergences. Pending bearish PPO crossover, a clean one too. So if I liked it back here, we did. We swung that down, got 8%. I like it even better here. And the action you want to see following a bearish engulfing candle, number one, you don't want to see the top of it get taken out, or it's no longer a topping stick. We did see that. And you do want to see, I like to see the bottom of that candle get taken out. Sometimes it happens a little sooner. It's now been taken out. So I just wanted to mention that. You can see here, I zoom in, we've taken out the low of last Thursday's candle. And remember, we had a truncated trading week, so you only have Friday, Tuesday, Wednesday, and now Thursday. So that's good. And as far as today's a good thread in the needle so far today. We came into the day, short hitting T2 right at the early this morning, but not early, not too early. The T2 right here had a nice bounce as expected. So that was the final target. That's why for an active trade. And again, I am compartmentalizing or separating the active trade and the long-term trade. And I spoke to that quite a bit in the last video, that although I expected a bounce, game to bounce, that was my target there, 18,729, and or the trend line ended up coming in. We got there quicker than had we gone up slower and hit the trend line as well. And then I got a post out to you, and it was hit that was my preferred scenario. With an alternative, we might push a little higher, but this is where that was what I favored. And so far, boom, spot on. So spot on exit, reversal, spot on reversal, back from the longs, game the bounce. And here we are. And then, like I said, that would be, that was an objective short entry. And then the break of today's lows was another objective short entry. But now look, I'll draw this here. You still have but then these 5-minute divergences, what'll happen, guys, and this is the reason, again, I do these long-winded videos. It's important to convey that, in a sideways, in a trading range or bull trend, these little 5-minute divergences will almost always play out for at least a rally, if not the move to next highs. But when you start getting 5-minute divergences, positive, aka bullish divergences on the short-term charts, 5-minute charts, 10, 15, following big, significant sell signals on the much more important daily charts or weekly charts, those tend to get overridden. And so, they bought it there as expected today, but they've already taken out that low, and that's that. So, And of course, when I jump over to this 15-minute time frame, same chart, but you're just seeing it. This was that support level. Like I said, it was pretty darn good support. So there's the, this is the NVIDIA rip. Oh no, wait, well, not NVIDIA. NVIDIA was more recent. This was the what rip? Oh, the breakout back above the trading range back then. That's what that was. So we broke out above the trading range or the downtrend line. I'm sorry. I remember the downtrend line on the 60-minute chart of QQQ. There's so much here, right here, and that's as expected. We ripped up to new highs, and now that then gave us that trading range there. Let me get back to that chart. Okay, we ripped up, and then after that rip, we established this new trading range, multiple pullbacks to that level, one little whipsaw, but snapped back up in there, went up to new highs, tested again this morning, or yesterday, or no, this morning, correct, and now we've broken it. Could it be another whipsaw? Sure. If it is, where did we go? Where's the next resistance? Well, we still have that trend line we got rejected on the other day, and that would also be the next resistance. However, if we continue much lower, and we do still look, we still have that the positive divergence I pointed out in the earlier video. These lines are getting wonky this morning, so there's still positive divergence on the 15-minute chart takes precedence over a 5-minute chart as far as the bigger move. If you get a 60-minute divergent low or high, that's even better. If you get a daily, when I say better for the longer term trade, the 5-minute charts are good for trades that are going to last usually hours, intraday trades, day trades, maybe a couple days, 2-3 days at most. You get a 60-minute divergent high or low, those are usually going to last several days to weeks, sometimes even months. And again, you get divergence on the daily or weekly, and now you're talking trend trades that are measured in weeks, usually months, sometimes even years if it's out on the weekly charts. All right, so that's it. Support broken. QQQ 60-minute chart. No, I'll give it to you. I have a 15-minute I gave you the other day. I showed you these parallel trend lines right here. Boom, boom. Saying that if we broke this one, that's that support we hit today. That's that same trading range I just showed you on the futures. And now we've taken out, we already took out the trend line there, and now we've taken out the price support level. And this is the next stop, in my opinion, right here for QQQ, unless they can rally this back up and get it comfortably up there today, which I would not personally bet on, and I am not betting on. By betting on it means I'd be long. So I stuck with my trading plan, reversed at the highs today, and have my fill of shorts again. And those are, I'll be swinging them down. And like I always do, if there's a good chance that I see a bounce of 0.5% or more with a high degree of probability and objective long entry, I'll gain that bounce. But again, I'm trying to tell you, I'm getting at this point, I will get increasingly less interested to game the bounces, because this is where I think we're going to be at that point of recognition. What I call, and I make a lot of terms up, POR, point of recognition, is where bulls, dip buyers start to realize, hey, something's not working right anymore. I keep buying these dips. I've been working great for a while now. And then you start to see stops get hit and longs take profit. And there is just a massive amount of hot air in this market. Couple other things, and then I'll get to my indicators. So we have that pending, about to be on any more downside, bearish PPO, high level, clean. Again, I like this clean separation between the two lines. Those are pretty good, the trend indicator, trend change indicators. The fact that it comes on the heels, this is SPY, flipped over to. SPY already broke down and gave us that. I covered that, I think, earlier. The breakdown, the bearish engulfing candle, the divergent high, and now the bearish PPO crossover. It's like, for me, check, check, check. And I know, I think from the lack of comments, I pulled short interest today on QQQ. Here, well, I don't know, I just show it to you. This is the short interest over last year for QQQ. This right here. Let's scroll back. Let me get that away from here. Let me zoom in a little bit for you. So this is your short interest in shares right there. 50, well, just under 51 million, coming off 24-week, 52-week low, yearly low in short interest. You can see that. Look where we were back a year ago, 73 million, 76, 74. You can see the numbers. What does this tell me? What exactly I know? And I can almost gauge it from the sentiment on just this site alone. Nevertheless, turn on the TV. Everyone's given up. the bears have given up. All but one here at least, and everyone thinks the market's going to go to the moon. Nvidia is going to just keep the market up forever. And what I'm about to get to is something I've showed you before. It's just the same story. We're going to look at a couple breadth indicators. Let me dive into those. But I just wanted to point out. And by the way, short interest, the one thing about it's so lagged, that's through May 15th. So let me just tell you this. So what I always have to do, because they report it only twice a month. And even then, once they report it, the next date will be probably today, but then there's I think it's a 11-day dissemination date. They wait almost 2 weeks before they report. In this day and age, it's archaic. We've just moved down to a T+1 settlement. From when I started as a stockbroker in the mid 90s, it was T+5, meaning you bought a stock. I'd phone my client and say, "Hey, Randy, give me some AT&T," or we'd buy it. Okay, no problem. And T+5 because they had to mail me a check. That's how old I am, and that's how old the system was. Then after that, we went to electronic trading. I remember we went down to T+3, meaning you trade a stock 3 days settlement after that, trade date +3, and now we're T+1. They just implemented. Anyway, times have changed, but where I was going, for the life of me, I don't know when they're going to speed that up, because that data is almost instant when they get that information, and so they're still using that archaic lag time. But either way, where I was going with it, here it is. I go off on my little tangents sometimes. All you have to do is kind of look at things. So QQQ short interest, that last reporting date was on the 15th. When was the 15th? Right here. So would your best guess be that more people shorted or more shorts blew out and covered and gave up? A pretty safe bet after this run, you could already see it going down. That's why you get low short interest, because the bulls are emboldened. Everybody's long. Nobody wants to short anymore. Shorts have capitulated. And that sets the stage for the bigger drops. When you have high short interest, it puts a floor under the stock market, or whatever security has the high short interest. Why? Because those shorts, I always say, are the only guaranteed buyers out there in the market. They must cover. When I short a stock or a futures contract or whatever, I have to buy to cover to close the position out. Longs don't have to ever sell. They can hold and die with the position, but if you hold a short position, you die, and you got to cover it then. So, or whoever's handling your account does. So those that's why. And short trade sellers tend to be more active. They're in and out. They're not like shorting something, holding it for 10 years, like people might hold on to Apple. All right, so let me get to what I was going to show you here. So, the longer term targets haven't changed. These are just intermediate term targets. We'll get to, if and as we approach the 200 days, I'll get to the other ones. So now let me talk to you about the indicators I want to get to here. Okay, here's one I've shared for many years. One of my favorites. To me, just a great indicator. And this is the NAAD. That's on stockcharts.com, $NAAD, NASDAQ advancing versus declining issues. So up top, you have the NASDAQ 100, and down below the advance and declining issues. Over time, this tends to drift lower due to certain NASDAQ has a whole pool of securities, always the ones on the bottom tier, very very bottom rung, falling off. But what you want to see in a healthy market, still a very good indicator in a healthy rally. This was after the 2009 financial crisis. That doesn't look like a lot here. It's log scaling, 55% drop in both the S&P and NASDAQ, roughly. And then what you want to see in a healthy run after that, the new bull market, is this line in going up. This run here, we had a sideways, two corrections, almost bear markets, deer market, we'll call it, sideways, about a year and a half of sideways trading. And then a nice, steady, solid advance out of that, leading pretty much into the COVID highs. Well, we had that Q4 2018 drop. And you can see, NAD was moving up. So in healthy markets, it is moving up. In healthy advances, it does move up. But what you want to look for, you got it, divergences. So the same thing on stocks and stocks or ETFs, futures. So what happens is, and this one takes a while to play out, because I use this not for active trading, not even for short-term or regular swing trading, more the trends, catching the bigger trends. And it has never given a false signal. It tends to work better on calling tops. You don't get divergence at lows, and I've put that in notes on one of my, I have different variations of this chart. I've noted that. But there it is. So you can see there the NASDAQ was heading up right into the peak. That was October of 2007. That's when that bull market ended. And you can see we were clearly diverging into that, right? Up until then, the advance was strong and AD was going up, so was the market. But then you started to diverge. And again, these divergences, again, since you're looking for major trend changes, are far, far, far from a timing indicator. They, like all divergences, show a condition, show a likely trend change pending, as long as they're there. And typically, the bigger they get, the bigger the drop. Okay, so that was a 1.4 year, 55+% drop there, clearly marked with that divergence leading up to it. And of course, since then, that was the last true, real big bear market. We had a correction there, double digits there, clearly indicated by the divergence there. Another divergent high. That was at two nearly 20% drops in the NASDAQ. The small caps dropped over 20%. You can call it a bear market. And the major exchanges went nowhere for over a year sideways with two big corrections within. So it would have been a good time to get out. And then COVID, again, not a random event, clear negative divergence on this indicator. 36% drop in the S&P 500, was a little less in the NASDAQ, but that's how much it was in the S&P. And then that last bear market, or initial leg down, I call it, that we traded there, with clear negative divergence going into the high. And then boom, we got that. I added this line today, this purple line here, because it's really just one big divergence. And that's how I've not wavered on that, waffled or whatever. It's, to me, it's when you look at the equal weighted or a lot of the small caps, mid cap, the universe of stocks, if you include all stocks in there, the vast majority have not gone to new highs. It's been fewer and fewer names. And that's what I'm showing you here. I'm going to show you with breadth indicators. That's what's showing you. So you had the divergent high there, and it gave you that bear market, which we traded with near impunity, both big counter trend rallies, catching them long. Then this one here, you've had, let me clear the lines. You've had the divergence since this point right here. The NASDAQ started moving up here. At that point, we were having, a nice, market breadth was better then, but we continued the same story after that. This whole leg up has been largely, again, a handful of big tech stocks. And so that's the current divergence. But taken from the bigger picture, it's this whole thing. From this point on, we've been making higher highs in the index with lower highs. And that divergence, I haven't seen anything that big since leading up to the 2007 top, followed by that big bear market, and back on the dot-com bubble, which was leading up into the late 90s, into the March of 2000 high. So that's one. I've covered this one many times. And again, I've been talking about it for a long time, and it's just getting bigger. A long time, and that's because it takes, again, years to play out. Why am I doing this? What's the point? Because it gives me an idea of the magnitude of the turn when it comes. Everybody out there that's on Steam, nobody's calling. I don't hear of anybody talking about a 55. Well, a few people, but you got to go to obscure. You're not going to find them on the mainstream media. They don't want to hear that. That doesn't sell. CNBC followers don't want to hear that the stock market may drop 50% from here. But let me show you another one here. So that's one. I've got a bunch, but I'm just going to show you a couple more. Let's go to QQQ, percent above the 50 and 200-day moving averages. I've shared this one a lot in the past, including recently. Again, phenomenal track record. I can go back farther. I have some charts. I'm just going back to 2018 here, but you can take this back as far as you want. An extremely reliable predictor of where the corrections and the rallies, the bottoms, are going to come from. This one, you had a big divergent low back here. But let me just go over it. You can see all my divergence lines, all right? I'm not going to, let me just show you what you're looking at. This is QQQ up top, or the NASDAQ 100. Down below, this is the NAA 50R right here, this guy here. The NASDAQ, the percentage of stocks in the NASDAQ trading above their 50-day moving average. And then just below that, I have the percentage of stocks trading above their 200-day moving averages. And guys, it's very simple stuff. Sometimes some of the perma bulls will come on TV talking about breadth improvement over a period, and you've seen bits and spurts of a few weeks here or there with an equal weighted start catching up some sectors. But this, if you take a step back and look at this, again, you'll see the big divergence leading in the top before the bear market in 07 to 09. Again, this was 2018. The big drops we had are the Q4 2018 drop, big negative divergence leading up to that. Indexes going higher with the percentage of stocks, both they're trading above their 50 and 200-day moving average, clearly dropping. Then we had that, again, big drop, roughly 20% drop. 31, it was actually 36. Oh, I measured here. QQQ says 31. It was 36 in the NASDAQ. But again, it was the divergence there on the 50, right? Stocks trading above their 50-day. Then you have this big divergence right here. This was very clear. And then you started to get it on the stocks trading above their 200-day moving average. Again, the NASDAQ ripping on up right into the 2021 highs in November when everybody was bullish except us. Turned around, we shorted that thing, had those targets. We hit T3 right there on my long-term targets. And then at that point, you had positive divergence at that low. Gave us this run up. But you can see here, I've added these lines here. We actually I put a dotted line here because this is a line right now. This is our current divergence line right here. This last thrust up clear, and it's really dropping off. If you look at the slope of the line, remember back in geometry or whatever it was, you had a flat line as a zero slope. That's a positive slope, a steeper positive slope, and then a negative slope. So you can see the slope really steepening off. So as we've been going up, this final thrust up has really seen this ratio plummet. Again, it's not a ratio. Yeah, it is. It's simply the percentage, again, of stocks trading above their 50-day moving averages. So that is a clear indicator that, in my opinion, that we're looking at not just a correction, but a pretty big, sizable one, or quite likely a end of a bull run in the next leg down in a primary larger bear trend. The other thing is, remember, we're fresh off new all-time highs, right? Let me repeat that. We are fresh off new all-time highs in the NASDAQ and the S&P, which are both top-heavy in NVIDIA and those guys. But yet, all along, this is the red flag. Back here, there was nice thrust and, the percentage of stocks above their 50-day moving averages was 70-something percent right there, right? That was pretty good. However, look how sharply it's been falling off. And then more importantly, we've been in typically bear market territory, correction territory. When you're below, if you just put a line, which I did, the red line at 50, that means 50% or half. So when you're below here, that line, over half the stocks are trading below their 50-day moving average. And you can see here on the 200 stocks, percentage stocks trading above their 200-day moving average, you really only see that, guys, in bear markets, or big correction mode. There was 24% drop as measured there in the NASDAQ, that Q4. We were below there. We stayed below it there. We went below it when COVID hit, right? We went below it in that last bear market. And here's the thing, we never went above it. So this is what I've continued to say, despite these little spurts here or there of improvement in internals, making the case that, to me, we're still in a this has been a big counter trend rally in a much larger secular bear market. Now, when am I going to be wrong? Well, I'll be wrong when this goes up here and these start making, you see the majority of stocks trading above their 200-day moving average. We haven't seen that. It's been rejected on every attempt going back all the way back till when the bear market started back here and we entered that level there. Again, on the 200s. 50 days is going to respond faster. But even on this last thrust up to new highs, that is very unusual to see this percentage of stocks trading below their 50-day moving average. You had it here. That's why that failed. Those new highs, this was a red flag. And I covered it back at the time. So anyways, take that one for what it's worth. And then the last one. This is the one I wanted to get to. I was considering it. I show it. Let's see. Okay, for those of you who've been around and doing this as long as I have or longer, you probably remember a lot of chatter, especially back leading up to, because I clearly do, before the the Great Recession, the big bear market we had when the markets, the S&P as well as the Nasdaq, dropped over 55% back in 2007 to '09. Leading up to that, we had several triggers on what's called the Hindenburg omen. Now you can look it up, or I can tell you here. So back then at the time, what I did, and it was pretty accurate. It fired off and it had a few, but then after that, it had quite a few false signals that didn't pan out. I kind of moved away from it, but I also, a couple years later, and this is decades ago now, took this almost the same criteria, but applied them to the NASDAQ. See, whoever invented this back, and I don't believe his name was Hindenburg, could be wrong, but I don't think that was it. Again, you can look it up, doesn't matter to me. The McClellan oscillator, here's the criteria. So what I did is I replicated to put it in a graphic form on this chart here. And so it's McClellan oscillator, it's negative. These are the criterias, and they must be met. It's such a big chart because there's so many criterias that unfortunately I have to scroll through here, or I can shrink it down this way so you can kind of get a visual on what I'm looking at here. That's the whole thing there. Let me see if I can move it up here. So this is what my chart looks like. Now I have it also for the NASDAQ, and that's what I'm going to show you here. So let's go back in. So basically, you have to have the McClellan oscillator negative on the day that the signal's triggered. It's triggered a one-day thing. Now sometimes you get a cluster of them, and it's not an immediate. Right now the market's going to crash, but that's what it is. It's a market crash indicator, meaning a big drop. Now it doesn't have to be Black Monday 1987. We'll never see that again. Just so you know, I've heard people try to talk and say we're going to see like that. That's a possibility. No. Because after 1987, the Dow fell over 20-something% in a single day. They implemented circuit breakers to make sure it will never happen again. Meaning they slow trading down. Uptick rule kicks in first. No short selling unless it's on an uptick. Then circuit breakers, they'll shut things down for a brief period. And if you exceed even a larger threshold, they'll shut trading down for the day. So just know that it doesn't mean the market can't go down 25% in very quick order. A few days of circuit breakers back to back will do the trick. But anyway, so that's one of them. The other, it says here, you probably can't see it, but I can zoom in for you. The daily number of NYSE new 52-week highs and the daily number of new 52-week lows are both greater than or equal to 2.8%. Of the listings there. And then on the this one, the number of new 52-week highs cannot be more than twice the number of new 52-week lows, though the new 52-week lows may be more than double the new highs. Again, these are the criteria as written, not mine. This is whoever created this. And then finally, the NYSE index is greater in value than it was 50 trading days ago, blah, blah, blah. Now, one reason I think this failed, I feel pretty strong on that, is back when it was created, and I forget when that was, but it was well before I started using it. It just became really popular back in, because we had such stable market environment up until 2007. There was years of pretty low volatility, and the corrections weren't that bad. The Fed wasn't so heavy-handed. But the NYSE, if you're not aware, many aren't, has a lot of ETF listings, and a lot of those ETFs they're non-related to the stock market. You have REITs or gold. You have inverse ETFs. So those, it's giving you false readings because inverse ETFs are moving opposite. So, and then also, you've heard me say this many times. To me, the Dow is grandpa's index. It's not relevant to the stock market. It's 30 stocks. It's not indicative of the economy or even the entire stock market. NYSE, nobody really quotes that anymore. So what I did, and I'm going to get to it here, is I used these same criteria, but applied them to the NASDAQ. And I'll get to that one here in a second. Okay, so here's my NASDAQ Hindenburg indicator I created a while ago. And you guys haven't heard me talk about this in forever and a day, no matter how, what my long-term outlook been, because it hasn't been firing. It's that thing about it, and especially since I then applied this to the NASDAQ, I think it's filtered out a lot fewer whipsaws for the reasons I said before on the New York Stock Exchange. So the McClellan oscillator is negative, and this is the NASDAQ McClellan oscillator, of course, now. So you have to have that negative on the same day. And same criteria here, except I applied it, as you can see here, instead of this, the stocks on the NYSE, it's the NASDAQ with percentage of stocks, the daily number of new 52-week highs, 52-week lows. And so those have to be both greater than or equal to 2.8% of the sum of the NASDAQ issues that advanced that day. So I figured out that formula there. And you can see the number of new 52-week highs cannot be more than twice the number of the 52-week lows, although the new 52-week lows may be more than double the highs. So this is the new highs, new low ratio. And so basically it triggered recently. And so it's unusual to get those signals. I just want to point out, in fact, I just eyeballed this. You really have to zoom in tight and go nitty gritty on it. Put up crosshairs. I'll do this here. And look down when you got it. But you can see here, so you got to drop, both of these have to drop below this line. This is what I call a thumbnail view. It zooms in on the most recent price, so you can see a lot clearer. And so there you can see is, that's it. So remember, it's spiking unusual, as I just told you earlier in the video. And as you know, last week, markets hit new highs, right? So obviously you're going to have some stocks at new 52-week highs, right? But what was unusual, and this is, I pointed that out at the time, I'm looking at a lot of stocks making new lows at the same time. And okay, at any point in time, especially in the universe of the NASDAQ stocks, there's always going to be some making new lows. Same thing in the NYSE. But when you're making new all-time highs, it should be a very small amount. But what you had here recently, you triggered. So you had the McClellan oscillator negative. You had both the number of 52-week highs and daily 52-week lows were greater than 2.8. That's that blue line there, guys. It's down here. And so, again, you can look back here, and I did it. And guess what? The only time I could see it triggering is right before the COVID hit. It hit there. Gosh, I'm sorry I did this a few days ago. I can't remember if we had we might have had one fire off before the market peaked back in 2021. We had that big drop. Remember in 2022, there were some big aggressive selling periods, big drawdowns. But overall, it's been pretty consistent. I just want to point that out. So we fired recently. Number of 52-week highs cannot be more than twice the number, and that's what 2.0 means. So you're below there, that's twice the number. So that was checked there as well. And the NASDAQ composite needed to be greater in value than it was 50 days ago. Obviously it was, making new highs. And boom, 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 check, 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 check. So look, does it change my positioning? No. Does it? But how do I use this? Well, it goes in conjunction with everything else I've been saying, looking at the breadth deterioration, the excessive, foam at the mouth bullish sentiment lately, as evidenced by everybody that the brief periods I've turned on the TV to check an economic report or NVIDIA earnings, coupled with even, people on this side here, and then people in the general public, talking to friends, family, people that usually aren't talking about the stock market, are getting all excited about AI and NVIDIA and all this other stuff. So it's in the air, guys, the potential. So where I'm going with it, it leaves the door open for me. If it plays out that way, I'm going to put this back here on this chart, for the potential for that, what the Hindenburg was created for, to predict or help identify potential market crashes. So what does that mean? So forever and a day, for a while, and we haven't gone anywhere. I've been talking about it here. These were the targets laid out. 1, 2, let me change colors here. 1, 2, 3, 4, 5. Color tool. T1, which we already hit. T2 at the button, reverse there. T3, T4, and T5, with the sweet spot being around the 200 days. But, back then and still now, I was predicting, when we get down there, we'll probably punch through them briefly. At this point, I am very much open to, based on the technical posture of the markets, based on sentiment, based on indicators like this, which are there for a reason. It's not voodoo. There's something wonky with the market when those criteria are met. Again, they've been very unusual, and it's actually, this modified version I've done with the NASDAQ actually has a pretty damn good track record. And so there is no exact timing to it, but it's usually imminent. And imminent, when you're looking at a chart going back, an indicator that only fires every few years, if that, means could be weeks, possibly months, but usually within a few weeks. And so all this taken together means that if it happens and we start to play out, we can smash through support levels as if they're not even there. Again, the algos are almost always going to buy, and humans will usually buy the first dips, even if you briefly undercut the 200-day moving averages. But it would not surprise me, and I'm going to tell you now, if and when that happens, I'll play it by ear, I'll be flexible, but I may not be looking to position long. My original plan, and right now it's still, let's just say it's still my current plan, is to, if and when we get down here, and we swing this down here, QQQ, let me change the color on this tool again. Somewhere around here, if and when the chart's confirmed, to cover swing short positions and go long for a bounce, a counter trend bounce, whether it's here, somewhere in here. However, based on everything I've talked to you about in this video and shown you, I am very much open to the possibility that I may just, at least especially in the longer term accounts, tuck some of that away and just sit tight and ride out any counter trend bounces, and then hold out for these longer term deeper targets I have. T4 still here, still maintain, that blue uptrend line and/or back. This was from back here. Remember, they would have come in together. We had other reasons. We bounced off T3 and had this rally. That target was hit. There was positive AK bullish divergence. So this is what I'm talking about. Like, I can't tell you right now if we get here what the charts are going to look like, but I can tell you if they look bullish and they tell me to cover and go long at that point, I will. But if they don't, I'm going to stay short. And it would not surprise me to see a very quick swoon down, much faster than it took us to drop that much last time, based on everything that I've just covered in this video. And one way to do it, you're like, okay, Randy, well, what do I do with that? Again, first of all, that's me. You do you. I'll do me. I'll tell you what I'm doing. I'll tell you what my thoughts are. I'll tell you when those thoughts change. But one way to do it, if you are open to that possibility, because the gain potential could be tremendous. Because again, if it plays out, stocks are going to fall a lot faster than they go up. So you're going to wipe out. You're going to wipe out all that 2023 rally, 2024 rally so far year to date, and all the 2023 rally, in my opinion, and all that, and that can go very fast. And so the gain potential is huge. Short here, drop 50%. Whatever your number is, everyone's different. You got a 100K short QQQ, you're going to cover it at 50. You just doubled your money. You pretty much sold it at 100, but then you're buying it later at 50. You're borrowing those shares. That's how short selling works. And I'm just picking a rough number on the drop there. It could be more than 50. Could be less. Could be none of that. But as of now, if it does happen, again, we may smash through these daily targets. I don't expect a straight waterfall sell, but I'm open to anything. That's what I'm trying to say. And I'll probably clean up this weekly chart, or even start looking over and paying a little more attention to this monthly chart I cover from time to time. You can see the monthly chart has some long-term primary. There's your secular bull market uptrend line off the 2009 lows, this yellow one right here. I had this one, the white benefit of the doubt, but the yellow is a big one, benefit of the doubt. And if that breaks, then I'm very much open to a move all the way down here. And potentially, in this one here, this is a big long-term secular bull market trend line that's really where this modern day bull market came from right here, off the mid-90 lows. And there's your uptrend line. You had the Great Recession hit that trend line, and that one's going to be, I'm just ballparking it down to if and when we get there. That'd be, again, if and when we get there, probably closer to 60-something% drop. I have to kind of go like this, because we're not going to drop that much overnight. I'd have to extend that out, and it's something just based on this and how quick stocks fall. Could be probably 2025 next year, maybe early 2026. We'll see. And again, I'm getting 10 steps ahead of myself right now. I'm going to just wrap this video up where I kind of began it. This is where my position is. So, you know, it just gets frustrating when people make these comments about these super long-term targets, but that's what I'm talking where I think things are going. It's kind of like predicting where you think the weather's going to be, you know, or we're going to be warmer or high. We're going to have a bad hurricane season 10 years from now, or a mild hurricane season. You know, I'm here in Florida, of course, so I'm talking about hurricanes. But this is, you know, these charts. This is a, you know, 15-minute chart. You go to the 60-minute charts. This determines how, especially in my active trading account, how I'm positioned at any given point in time. And so right now, as I wrap the video up, we hit this previous reaction low. They may buy that. You still have some divergence there, but like I said, this was a pretty significant breakdown, and I think we'll continue lower probably tomorrow would be my guess. ES, S&P 500 futures. Look at that divergence from it's getting bigger right now. Now we have it. Oh, now we have it on the RSI. So there's every reason and then some for this market to bounce right here. So it's not a crazy all-in super aggressive short. We're just right off the highs. But I think we have the bull by the horns, metaphorically speaking, with those bearish engulfing candles. If you shorted them that day, or the kickback rally, or the short entry here, any of it, this is the current, you know, average cost on the current short, swing short, trend short. And so, and with a stop still, you know, maximum stop a little bit above there, as I mentioned that day, last Thursday, 1, 2, 3% if you want to give it some room, or you can at this point trail it down and you know, and put your stops at break even so you don't lose anything if we go back and make a new high. That's about it. I just wanted to cover those breadth indicators, like I said, and we'll see for kicks and giggles if that modified Hindenburg omen that I use with the NASDAQ data proves to, you know, once again work out for a major drop in the market. So I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend. Or, I'm sorry, great day. Today's Thursday. One more day to go.